Hello and welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Chief Investment Officer.
Matt Mondoux, Senior Financial Advisor.
And Dan Seder, Managing Partner.
So, same playbook as usual. We've got a few different topics that we want to dive into and explain why we think it matters. First and foremost, we're going to talk about some volatility that's been experienced amongst big tech and artificial intelligence related stocks. We'll have a brief discussion on the Federal Reserve, have some recent updates there on the interest rate front. And then finally, we'll talk about the government shutdown, how some of the data being delayed is starting to weigh on markets, and close up with some commentary on credit concerns in the U.S. Am I missing anything, guys, or are we ready to jump into it?
Let's do it.
Let's roll.
Okay. So, mentioned big tech, artificial intelligence-related stocks suffering some volatility. We saw specifically last week, so that would have been the week of November 3rd, you saw a fair amount of volatility, especially among those tied to artificial intelligence, ending the week in a bit of a whipsaw fashion, closed higher on the final day of last week. I think that was November 7th, but not before a pretty meaningful drop. The combined market value of several large artificial intelligence-linked firms, think Nvidia, Meta, Oracle, and others, fell by roughly $800 billion in just 1 week. So why does this matter? Well, this is somewhat piggybacking off of a topic we've talked about over the last month. It just signals that investor optimism around unlimited growth in AI is starting to be questioned, especially when you have valuations where they are and whether CapEx spending on artificial intelligence will actually yield the returns that are expected. The other reason why this matters is because if you start to get this tech drag, it can ripple into broader equity markets. So, of course, when you have these artificial intelligence cohorts underperforming, it's no surprise to see the NASDAQ underperforming. So the last thing I'll say is that it just raises the question that keeps coming about is this AI trade cooling? Should we be shifting portfolio allocations? How much of an impact are we going to see on corporate earnings, and what's that going to do to broader risk appetite in the U.S.?
The only thing I would add is we don't know if the AI trade, the quote unquote AI trade, is cooling. We don't know what the future has in store, but the one thing I know is stocks don't only move in one direction. And so you have a slight hiccup in an asset class like this or a sector like this. And well, yeah, 800 billion, that's a big number, but the market cap, the valuations of these companies are through the roof. We're talking about $4 trillion companies nowadays. And is the next company going to be 5 trillion? And so I think you got to take it all with a grain of salt. Stocks, any stock, any sector doesn't just move in one direction. These stocks have pretty much moved in one direction. So I think a hiccup is warranted and nothing but normal.
Right. And I guess the spin we have put on it is just that because we don't have a crystal ball, what we do know is that the capital expenditures related to artificial intelligence are very real. You can go look through data points like industrial production and you can kind of get a read on how much of this money is actually being deployed. And it's a very, very real experience that we're having. What we don't know is if the market's going to continue to price up these shares of these companies. And so that's where what I would say is portfolio sizing, position sizing, that's what really needs to be considered right now. Because like you said, these names aren't just going to move in one direction in perpetuity. So you just need to make sure that you are comfortable with some level of volatility. And I think you have to have a closer look at how you are actually sizing positions.
And so CapEx is real, but I heard something else that I thought was interesting over the weekend, and I don't think the data was that old, but someone was talking about are the valuations and some of these tech companies really extended. And Nvidia was trading at a 35 times multiple. Well, a handful of years ago it was at 90 times.
Right.
Right. So there's CapEx, there's earnings. These stocks, while they're extended, they're probably not red hot in terms of how overextended they are. So I think everybody needs to settle down.
Yeah, I mean, Daniel, I think a couple of points that you made. I mean, number one, the CapEx is real. This is not 2000 building fiber optic cables to nowhere. Nobody's buying Nvidia chips and storing them in a warehouse or in a closet. So it is real. Where I am focused, or the one thought that, or my big takeaway from those comments, though, is that the tech drag can ripple into the broader equity markets, and that can be the concern. And could we expect to have a year where markets really trend sideways, or 2 years where markets trend sideways as large cap tech grows into these valuations? I mean, right now you have the S&P 500 equal weight, so taking 500 companies, equal weighting them, up less than 7% year to date. You have the S&P 500 up over 16%. The NASDAQ 100 is up over 20%. So again, the market returns are being driven by large cap tech, and I think investors need to start to prepare themselves mentally for a period of time where these large cap tech companies don't pull your portfolio up 10%.
Yeah, I think that's very well said. And I'll just boost a LinkedIn post I had from last week that shows just how meaningful that tech bump has been. So if you look at October in the S&P 500, 92% of the 2.33% S&P 500 index return for the month of October was driven by information technology. I'll take that one step further and say at the headline index level, the S&P 500 index was up 2.33%. The equal weighted S&P 500 in October was down almost 1%. So that just shows you how massive the drive of these tech shares has been, and why when you get a different environment where tech is not red hot, how that can be a completely different market experience, if you will.
Yeah, and this is the earnings growth is coming from tech. So to be fair, this isn't just bidding up something without any
Correct.
backing. I mean, there is justification, but I think what we're saying is these companies might not always just save the day and pull the broad markets up as much to the magnitude they have the last 3 years.
Yeah.
Okay, what's next?
Yeah, so somewhat related, but we'll talk about the Federal Reserve. Week and a half ago, we had the Federal Reserve cutting interest rates, but signaling caution. So the Fed met a week and a half ago, reduced its key policy rate by 25 basis points to a range of 3.75 to 4%. But what was more focused on was that Chair Jerome Powell and his colleagues emphasized that further cuts are not guaranteed and that data will determine its path. So I think that's important because, let's call it going into this meeting, I think there was a fairly high likelihood, at least priced by market participants, that we are going to get another 25 basis point rate cut in December. And that is certainly not a foregone conclusion at this point. And why it matters is because rate cuts are generally seen as fuel for stocks, cheaper borrowing, more liquidity, et cetera, et cetera. But when you have the central bank start to signal restraint, markets just might respond a little less enthusiastically. So this pause and certainty around future cuts means that investors must reckon with a world where monetary support might not be as strong as previously hoped. And so this combination of cut now, but maybe no more soon, introduced this decisive shift in monetary policy expectations, which don't just affect bond yields, but they also affect valuations among stocks in the U.S. So still kind of grappling with this lack of data availability, which makes it really hard for investors to try to game this all out.
So I mean, the commentary from Powell's just logical, right? I mean, if he starts to indicate that they're going to cut a bunch in the future, then the markets are going to rally and rip, and we're going to be back to a situation where inflation could pop up and be more of an issue. So they really, again, have to strike a fine line here with keeping, the dual mandate, so to speak, in focus, which is, to control inflation and to maintain full employment. So I think these, with where the economy is at right now, the economy is doing just fine. Obviously we've talked about, or people have talked about it is really driven by the top 10% and, other cohorts of people are struggling, but I don't know if that's necessarily different this time. I think that's, unfortunately been a common theme for a while now. So at the end of the day, I mean, inflation does affect some of the people in the lower income levels more than the higher income levels. And I think that, this mentality and this commentary just makes sense with where we're at.
Yeah, I agree with you. And it's just in this hard position right now, which we'll talk about the government shutdown and how some of the data delays are weighing on markets in a moment. But, the Fed is somewhat flying blind. We were supposed to get another jobs report last Friday. We didn't. Same with the September job report that we never got. So with the fact that labor has been the primary reason why the Federal Reserve has embarked on this cutting trajectory, it's no surprise that Powell's going to hedge his language a little bit, right? So we do kind of just have to wait and see, right? Underlying economic growth is still fine, but as we get more data availability, you'll see people start to game out what the rest of the year and the next 6 months really look like. So as I kind of alluded to, we have this situation where at this point, the longest government shutdown in the U.S. in history, the delayed data that is resulting from this shutdown is starting to weigh on markets. So in the U.S., this ongoing shutdown has led to a lot of delays or suspensions of key economic data releases. I mentioned the jobs report, but that's just one of many examples you could cite. At the same time, you have investor sentiment that's being impacted by this uncertainty around fiscal operations. So why all of this matters is because economic policy and I would say markets in general thrive on data. When key releases like jobs reports or inflation data, et cetera, are delayed or missing, this just raises risk because there's more uncertainty. So right now you have markets that are becoming more sensitive to unknowns. What is the true state of growth or what is the true state of inflation right now? So you might have risk premiums start to increase. The shutdown also adds to some political and fiscal risk, which can feed through to credit markets, bond yields, investor confidence. So all of these little items are interplaying with one another, and it's just starting to weigh on markets a little bit. You've seen it actually pop up in investor sentiment as well, which has gotten incredibly pessimistic, all while the market is hovering around all-time highs, which is a pretty interesting dynamic right now.
Yeah, and it's having a real-world effect on travelers, right? So flights are being delayed or canceled. So I don't know. My gut says that this isn't going to persist forever. I think we're getting close to some kind of solution here. It's just not going to continue.
Yeah. The uncertainty is, I don't want to call it healthy, but it's to be expected, right? Okay, we'll wrap up with some talk on credit markets in the U.S. You have had some credit concerns in the U.S., specifically around regional banks, start to spark some market jitters. Several U.S. regional banks have disclosed significant credit or bad loan/fraud issues, which has prompted some sharp declines across the sector and stoked some renewed worries about underlying credit quality. Why does this type of item matter? Well, banking credit really is a foundational part of the plumbing in the financial system. If regional lenders are starting to show signs of stress, that's when you have some contagion risks start to rise. So investors might start to become more cautious about lending, refinancing, and the general health of, say, commercial real estate exposures, especially as regional banks tend to have higher exposure there. I think the bottom line is a shift in the perceived safety of banks or credit markets can, again, trigger some broader equity market or bond market reaction in a risk-off manner. So I wouldn't say the house is burning down, especially because the underlying data on things like loan delinquencies, which are really good reads on underlying economic health, have all been fairly solid. But whenever you get these types of, let's call it, bad loan or fraudulent loan type press releases, I feel like people are still recovering from the 2007 experience.
Well, it's something to be aware of. It's for awareness. We're aware of it. Jamie Dimon says, and he said I probably shouldn't say this, but when you see one cockroach, there's probably more, right? And so, this is just it's one of those things that does happen from time to time. Banks aren't going under, but they're just taking charges, one-off charges, which means they're writing down loans effectively to less than what they were issued at. We don't even know the magnitude at which they're writing off the loan.
Talk about spreads. What are you seeing in spreads?
Yeah, this is interesting because I think the headlines you're getting right now from the last 2 weeks is that credit market spreads are widening, and that signals some increased caution. So credit market indicators like the spread between yields on U.S. corporate bonds and comparably safe U.S. government debt, when you have those widening, that generally suggests heightened investor concern about economic and credit risk. But what the press releases aren't telling you right now is that we had credit spreads at such a low level that really the only direction that they can go is higher, right? Generally speaking, credit spreads widening is a classic risk-off indicator. It just means that investors demand a higher premium for holding corporate debt relative to safer, call it U.S. government or sovereign debt. I think
levels they're not at concerning levels.
No, they're still, at least if you look back through history, at tightness levels that are very uncommon. And again, I don't think there's anything to write home about here. If you talk to bond market investors, it's really challenging for people to rationalize paying up for corporate debt right now. Spreads are just so unbelievably tight that you've had a lot of fixed income portfolio managers have to kind of get creative for, call it, a similar experience like investment grade corporate bonds that they're just not willing to pay up for. So for what it's worth, even though you might see some spread widening in credit markets from here, overall levels are still very low.
And we have some lines in the sand when we talk about making portfolio decisions and portfolio action from a blue chip standpoint. We monitor these levels closely, and we have some lines in the sand that do cause us to get defensive or take some action should it be warranted.
Yeah, 100%. And
and we're not there yet.
Yeah, for full disclosure, we're not even close to there yet. So certainly worth monitoring. But just to kind of summarize, spent some time talking about big tech and AI stocks and the current standing there and what's gone on over the last couple of weeks. Talked about the situation going on within the Federal Reserve, and then finally some stuff on government shutdown and some credit flare-ups. Anything else to add before we close, guys?
No, that was good.
That's it.
Okay. Well, as always, thank you so much for joining us for another episode of Blue Chip Now, and we look forward to speaking with you all again soon.